Hey, and welcome back to our Abacus Jack channel on YouTube. Today we're going to cover something a bit more educational, and we're going to be talking about directors' loan accounts. So welcome back if you're a subscriber, or if you're new here, then hi, I'm Antonia. I'm an accountant and a small business owner, and I'm here with Andy, my business partner. So directors' loan accounts are something that can get people in trouble, and they can be a little bit of a dark art of accountancy. People have heard of them sometimes. People don't know what they are. Sometimes people see them on the balance sheet and it isn't explained to them. So, Andy, could you perhaps give us a rundown of what is a director's loan account?
Absolutely, yeah. So a director's loan account is actually it's a concept that exists for every limited company. Whether or not you use one is obviously a sort of bespoke client by client thing. But the best way to think of a director's loan account is it's essentially a float that can either be either have money in or it can be overdrawn, a bit like a bank account, really. So as a director, typically you are responsible for directing the business, and that includes directing the finances. But you're also going to want to take money out of the business because that's where you're working. There are only three ways you can take money out of a business as a director. One is a salary, you pay yourself like an employee. The second is you can share the company's profits if you're a shareholder, and a lot of owner-managed businesses will be director and shareholder. But dividends, it has to come out of the profits. The third way is the director's loan. So as it says, this is a loan. So the company can loan you money as a director, you take it out of the business and you spend it on what you need to spend it on. But the word loan is critical. So this is not income. This is money that you have to pay back to the business. And there's timescales and rules and regulations around that, which we can cover. But what if you're putting money into the business? Again, a concept that's quite common when you're starting up the business. You need to invest in equipment, marketing, services, subscriptions, insurance, all these things that the business needs to pay for in its early days, perhaps before it's getting any revenue. So quite typically, a small owner-managed business will therefore rely on the director putting money into the business. So his or her own money going into the business. And this is where this concept of a float comes in, because in that case, it's the reverse. The company owes the director that money. Again, it's a loan. The word loan is key. So you're quite entitled to therefore have some sort of agreement with your own business that you're going to get that money back because it's money that you've put in. And you could set up a loan agreement. In fact, we would encourage you to have a loan agreement that actually says, when am I going to get this back? How often am I going to get the installments back? And when's it going to be repaid? Now, typically, we'd recommend that a director's loan is repaid to the director when it's not going to impact the other activities in the business, so when the cash flow allows. But it's tax-free because it's a loan, not income. So if you've put money into your business, you can take that back out when the company can afford to do so. But when the company has given you money, again, you have to put that back into the business within certain rules and regulations. But those rules and regulations are quite defined. So I think it'd be useful if we kind of visit what those are in terms of what they mean for people.
Yes, so if you have a director's loan account that is overdrawn, then effectively you're receiving a benefit. And because you're receiving a benefit, that means that you have to suffer some tax on that, like if you're receiving any other benefit out of a company. Now, with a company, everything that's spent in the company is meant to be wholly and exclusively for the benefit of the company. And that's why when you use company assets, like money, for a personal benefit, that's why there's a charge on it. So if you have a director's loan account and it's overdrawn, and that means that you've taken money out of the business bank account into the bank of the director, let's call him David, for example. So the bank of David has taken £2,000 out of the bank of David's company, and that means that it hasn't been voted through as a dividend, or it hasn't been reported as a payroll expense. If it was done in either of those ways, then it would be taxed at source, either through self-assessment or pay as you earn, and you pay the tax on it. So you can't just have other money coming out of the business, which is the business asset. It's a different legal entity to the director. Therefore, it is a wholly different company in terms of you can't just take what you want out of it. It has to be explained. So the director's loan account, if it's overdrawn by £2,000, David needs to pay that back to the company. Now he gets 9 months to do that. So effectively the year end happens in March. He's got till December to repay that director's loan, or else you get taxed on it. And you'll be taxed at 33.75% on the value of that loan that year, and that would be added onto the company's corporation tax. Now that's quite expensive, and it's something that you want to get out of as quickly as possible, because that will happen the year after and the year after and the year after that for as long as it sits there. There are different ways. If David needed to borrow some money off the business as an actual loan, then if the business actually puts some interest charge on it, then that wouldn't fall into this circumstance. But if he repays that loan within 9 months and a day, then he could remove that charge from his corporation tax, and he wouldn't have to pay as much corporation tax when it's due to HMRC. How could David repay that director's loan if he needed to?
Yeah, that's a good question. There are several mechanisms, if you like, to repay a director's loan. The obvious one is you just put the money back in the business. So you've taken it out as a loan, you've used it for something, put the money back, clears the loan. That's fairly self-explanatory. The problem we see a lot is that money comes out the business as a loan, but it's spent. So how do you repay it? One thing you can do, which I think we don't genuinely recommend, but in a profitable business, you can declare dividends to the sum of the loan. So effectively, you're shifting the movement of money within the business. So you're saying that instead of actually physically taking the dividend, you're going to use that money within the balance sheet to clear off the loan.
So where does that dividend come from?
So the dividend has to come from the profits that the company makes, or in particular, the post-tax profits that the company makes. So the company makes a profit, it pays tax on that. Once that tax is factored in, you have a distributable profit or a post-tax profit, and you can pay dividends from that. And you can use those dividends to clear off the loan balance. In other words, you're not going to physically take them out of the business, you're just moving that money around on the balance sheet. Personally, I think it's quite a risky strategy. There's nothing wrong with it, but what often business owners find, if they are taking money out as a loan and then they're not able to pay that back physically, is they also are starting to rely on the dividends. So if you're saying to a business owner, actually, you can't take your dividend physically because we're going to use it to repay your loan, that in itself then causes problems. And it goes back to good strategy, good planning, good process. And we always recommend people have a really fine-tuned balance between salary, dividends, and if necessary, a loan account. And that's really important because we all need to make a living from our businesses as directors. That's absolutely fine. But it doesn't just mean that we can hammer a loan account or hammer a dividend account. We should have that balance between the different mechanisms that we've talked about: salary, dividends, loans.
Yeah. I think it's important to talk about how David might have got into this situation where he had a £2,000 director's loan. And it comes back to the wholly and exclusive nature of business expenses. So if at the start, for example, we talked about the positive director's loan, if you put money into the company, because the Bank of David, his personal account, is paid for Company of David's expenses in terms of the kit that he needed to start the business. The opposite is true when it goes to David has spent the bank of the company money on stuff that he wasn't meant to. So this is also why you need to look at what you're doing throughout the year and also work with your accountant throughout the year to check what you're spending is going to be allowable, because if it's not allowable, then it ends up in the director's loan account, and that can cause the negative balance. Even though you haven't taken that money out of the business, if you've spent that money on things that you weren't meant to, then you've got a problem.
So maybe Dave booked a holiday and he used the wrong card to make the payment, and he actually used the business card, because we have actually seen that scenario.
Yeah.
and Dave's been on holiday, so he spent all his money and he now can't afford to pay the loan back. And it's problems like this that then start to sort of manifest. Often it comes down to sort of good planning around the loan account.
Yeah, definitely. And just repaying it as quickly as possible.
Repaying it as quickly as possible, and certainly, as you say, within the 9 months of the company's year end. That's the key figure, isn't it? Because that's when the tax that you mentioned would kick in. It's called S455 tax. You also mentioned a little bit about loans being treated as a benefit in kind. So when would that really apply in terms of the level of the loan? Is there a threshold where that kicks in?
Yeah, I think that's around £10,000. So it's got to be quite a big loan there.
So once the loan goes above or equal to or above 10,000, it needs to be declared on the individual's personal expenses and benefits from the business, which in itself then brings personal tax.
Yeah.
So if I was listening to this video, I'd kind of be thinking at this point, I'm not sure directors' loans are really very good at all. So would there be a situation or an example where actually it is a good idea to take a loan? Is there any a positive influence in terms of taking money out of your business as a loan?
So it depends on how much disposable income you have yourself, and also like the cash position and the profitability of the business, because what a director's loan can do is it can actually buy you a bit of time. So if you wanted to buy something personal through the business and you could afford to repay that back to the company within that 9 months, then it almost gives you a little bit of flexibility to put a personal expense and get that line of credit effectively without having it on your credit profile.
So like if you needed a new car and you were going to buy your car personally, but maybe you had to sell your existing car, it's almost like a stopgap, isn't it? You can borrow the money from your company to purchase that new car personally. And then when you've sold the other one, you use that to pay it off. Plus obviously any difference. So I guess that's a scenario where it could be quite a useful way of managing your own personal cash flow.
Yeah.
You'd have to be quite disciplined to do that.
100%.
Yeah.
And often when we see these directors' loan accounts, it's often a little bit of lower awareness and accountability that can cause some of these issues. So it's like discipline and consistency as well. But also I think we touched briefly on like the dividends as part of the income strategy. And we get like everybody needs something to live off, and there's a target amount that they need to receive into the bank account to cover their monthly obligations. But when that is mixed in salary and dividend, and say your profitability goes down, if you keep taking that same thing for a year and the profits aren't there, then you will drive a negative director's loan balance, which will cause you more tax, which will hurt your cash flow more because you haven't had the profits. And it just digs you into a deeper hole every time you do it. So what you have to do in that situation is try and eke it back to a salary approach rather than a dividend, because a dividend goes from profits, but the salary is actually an expense, and it will kill your profitability a bit more, and it will hurt your cash flow a bit more because it's an expense, and it's expensive with like the employer's NI, but it'll protect you personally, because if that company doesn't trade, in the future, for example, you have a director's loan account, you can't afford to repay it, you still need to take money out of your account every month. If that company fails because actually you've lost your customers, and you're not profitable anymore and it's not worth doing, if that company folds, then what's going to happen to that director's loan account?
I guess they're going to come and ask for it. Yeah, that's personal liability. So the message I'm getting here is really it's important to work with your accountant throughout the year to understand the financial health of your business, and part of that is understanding that the loan position. Does the company owe you money, and can you get that back? Or do you owe the company money? And if so, what's the strategy that you're going to employ to put that money back in? I think it's one of those classic scenarios where if it's left uncapped, it's left untouched, it could really become a problem. But if it's managed well and it's done for the right reason, with the advice of your accountant, then actually it's another useful tool that a director has in their arsenal. So
Yeah, I did one actually with a director's loan account that was quite successful recently. So with dividends, you get a dividend allowance of, it's like £500 a year now, but 3-4 years ago it was maybe £2,000, then it was 1,000, then it was 500. So if the company's profitable but the cash position isn't good, you can still vote those dividends through. And if they're not taken, then they sit onto a director's loan account, and that can build up like a savings account in terms of the business owes you that money back. So if your company is more of a side hustle, so you don't need to take like a full salary from it, but say you want to go part-time and, you know, do a day in the company, and because you're going part-time, your salary's reducing, so you want to top that back up with what the company's doing. I worked with a client who had a director's loan balance that was owed to them, and we managed to get, I'd say, 12 to 18 months out of that director's loan account to support that working model before they actually needed to take any dividends that she would suffer tax on, you know, or, you know, get into a position where there wasn't any cash left and stuff like that. So
wow, so that's really good advice. So use your annual dividend allowance, even if you can't physically afford to take the money out, you're almost accounting for that within the company's finances until such a point in time as you can afford to take the money out. So the director's loan is really useful in that sense. It's a kind of like a holding station, isn't it? A holding pot for that money to grow each year.
It's just more flexible for people.
To give you the flexibility, yeah.
Yeah, so I mean, that works,
advice.
and I'm happy that works out for the clients. Is there anything else you had on director's loans you wanted to mention?
I think that covers the main things. Act with caution, and as always, seek the advice of your accountant before you make assumptions on how to manage loan accounts.
Yeah, I think the only thing I would add is if you want to check your director's loan account and you want to see where it's at, then go to your balance sheet of the company, and if it's an asset, that means that you owe the company money, and if it's a liability, it means that the company owes you money, and that's how you can check. And you can check that once a month if you really want to. Cool.
Great advice there.
All right then, thanks for watching again. Subscribe for more videos around these kind of things if you found that helpful, and if you found it helpful, we'd really appreciate it if you could like the video too. Thanks a lot, and we'll see you next time.
Thanks for watching.